I was sitting at Carl Icahn's dining room table with Icahn and his wife eating Mrs. Icahn's meatloaf. It was a lovely spring evening, Wednesday, May 29, 2013, and Carl Icahn was trying to take my company away from me. It was truly a surreal moment in so many ways. That May evening was almost the precise midpoint in a 9-month drama in which the personal computer company I started in my freshman dorm room at the University of Texas in 1984, the company with my name on it, tilted E and all, almost slipped away from me, and then changed forever, changing me along with it. I'd like to tell you that story and a couple of other ones besides. The year 2005 dawned bright with promise for Dell Incorporated. Apart from the blip in the dot-com bust 5 years earlier, a correction that affected not just us, but tech companies across the board, Dell had enjoyed a pretty uninterrupted run of growth in revenues and profits and cash flow for 2 decades. In January 2005, our share of PCs sold stood at a robust 18.2%. In February, Fortune magazine named us the most admired company in America. Dell, they wrote, was thriving in an industry that may technically qualify as being the poorest state in the union. Its profit margins in this margin squeeze business soared 15% in 2004, a feat that makes Dell look boringly routine. And now it's the first PC maker to hold the rank of America's most admired since the original PC maker, IBM, logged off in 1986. By September, though, things had begun to change. A lot. Though our profits rose 28% in the second quarter, total revenue was several hundred million short of projections. We were, as the New York Times reported, wrestling with the same questions facing other mature technology companies that ranked among the high flyers of the 1990s. How to increase revenues when it's already so big? Compounding the problem was the fact that personal computers and laptops, which accounted for roughly 60% of our sales, were no longer the rich profit center they used to be. As prices dropped over the course of the year, we had to sell many more PCs just to keep up with the previous year's revenues. Interviewed by the Times, our CEO, Kevin Rollins, blamed himself for the shortfall. Frankly, he said, we executed poorly on managing overall selling prices, especially on machines sold to consumers. Yes, you read that correctly. It wasn't a typographical error. Kevin Rollins, not I, was the CEO of Dell Incorporated that fall. I'd stepped aside from the position in July of 2004, and Kevin had taken over. Though taken over isn't exactly the right way to put it. I remained chairman, and the two of us continued to run the company together as we had for a decade. Not really much changed except for our titles. And so if there was blame to be laid for that revenue loss, I shared it. But it quickly became apparent in late 2005 that underperformance wasn't an anomaly. Dell was beginning to hit serious headwinds. For one thing, our competitors were getting smarter. Companies like Hewlett-Packard, Acer, Lenovo, companies we had soundly defeated with our build-to-order model, had gone back into their cave and figured out how to duplicate many of our supply chain innovations. Meanwhile, build-to-order itself, so effective at addressing the many combinations and permutations of desktop computers, lost its advantage as the industry shifted from desktops to less easily customized notebooks. Customers were starting to focus more on services and solutions as the value transitioned from the fundamental client product, the PC and related peripherals, to software, servers, and the data center. It took us a little bit longer than we would have liked to figure all this out. And then there was a Dell Plus that was subtly turning into a minus. For a few years, we'd been prioritizing profit over growth and share, and a company's success is always a balance between those three. Our profits were strong in the 2000s, but now our share was eroding, and that can be a slippery slope. We needed to build new capabilities, we needed to invest in new areas, and we needed to move fast.